Hey traders! In this video, I'm going to reveal one of the most important concepts that you need to understand as a trader, and it's called smart money concept. Whether you're a beginner or an expert, understanding this concept is vital for profitability as it gives us insights into how major institutions like the big banks actually trade the market. So, let's begin. But first, if you've traded before, I'm sure most of you have encountered this exact problem. So you look at a chart and you've identified a support level based on past rejections. Then, as the price approaches that level, you anticipate that another rejection will occur, which leads you to open a buy position with a stop loss placed slightly below that support level. Surprisingly, the price did not reverse as expected, but rather breaks through the support level hitting your stop loss, only for the price to rebound in the direction that you initially predicted. Now, for most of you that experience this, I'm sure you'll find it really frustrating. But what most traders don't know is that this is actually a common manipulation tactic that the smart money use to control prices and steal profits from retail traders like us. And so, who are these smart money exactly? Smart money are actually investors that have large sums of money. Think of it like the big banks, institutions, or hedge funds. And so, because these investors have a large amount of capital to trade, they are actually the ones moving the market. Meaning, if we're able to somehow figure out their way of thinking, or even better, knowing what their trading strategy is, we can use it to our own advantage and make a profit. And so, with that being said, here are several smart money concepts that you must follow in order to increase your win rate as a trader. Smart money concept number 1. Supply and demand areas. One of the key concepts to understanding how smart money works is supply and demand areas. Supply and demand are levels that show a significant amount of money is coming in or out at that one particular price range. This can also be referred to as liquidity zones, as it indicates the presence of liquidity, suggesting that institutional traders or smart money may enter or exit at these price levels. In the future, these areas can then be used as key levels to help us identify trade opportunities. Here's one example. So in this chart, we can see here that the price pushed upwards, indicating that there are more buyers than sellers at this level, meaning the demand at this level exceeds supply, which is why the price went up. And so because of that, we can actually draw a demand zone at this level, right before the price went up. Next, as the price approaches the demand level once again, supply and demand traders can use this same key level as a possible buy entry, because price tends to react to these supply and demand levels. And so if the price were to rebound upwards after hitting the level, they would have made a profit. This is just one example on how traders could capitalize on the supply and demand zones. Now, I'm sure some of you would notice, this works a lot like support and resistance levels. And you are correct, they are similar. And so the question is, what's the difference between support and resistance and supply and demand? This is a question that people still often get confused. So the answer to that is how they form. Let's first start with support and resistance. Support and resistance forms when price retests a level with a minimum of 2 times. For example, so in this chart, we can see that price went up, goes down. Then, it went up again, hits the previous level, and comes back down. And so because it already retested the level twice, we can call this a resistance level. Same thing with support. Here, we can see price went down, goes up, comes back down again, hits the level, and went up. And again, because it retested the level twice, we can call it a support level. Now, let's compare that to how supply and demand levels form. So, in this chart, we can see that price went up, as shown by this big green candle, indicating that there's liquidity coming in at this level and that demand exceeds supply. Because of this alone, we can draw a demand zone at this level. And that's it. It's that simple. We just have to find an area where price moved significantly. Same thing with supply level. So here, we can see that supply clearly exceeds demand, as shown by price heading downwards after hitting this level, which means that smart money or big institutions are selling heavily at this price level. Because of this, we can immediately draw a supply level here. Now in the future, price may actually react to this level and retest it. Like in this example, we can see that price hits this level and reverse downwards. And so, because price have now retested this level twice, the supply level now becomes a resistance level. So to summarize, supply and demand levels are actually just support and resistance levels that hasn't been retested yet.